Ever wonder how a company knows exactly when to count the money it's earned? Well, that's all governed by a super important accounting standard called IFRS 15. Today, we're going to break down its powerful five-step model, the framework that pretty much reshaped how companies report their revenue. Okay, here's our game plan. We're going to start with the why, what was the problem that needed fixing? Then we'll walk through the 5 steps, following the journey of a transaction from the initial handshake all the way to putting that revenue on the books. Let's dive in. So why the big change in the first place? Well, before IFRS 15, things were a bit of a mess. Recognizing revenue was like navigating a maze. You had different rules for construction, different rules for selling goods, even separate little rules for things like customer loyalty programs. It was complex and, honestly, pretty inconsistent. I mean, just look at this. The accounting world was juggling this whole patchwork of older standards. You had IS 18, IS 11, and a ton of other interpretations. Then IFRS 15 came along in 2014 and basically swept all of them off the table, creating one single logical framework for pretty much every company out there. And this whole massive standard boils down to one single core principle. It says a company should recognize revenue to show the transfer of goods or services for the amount it expects to get in return. In other words, the revenue you report has to tell the true story of the value you've actually delivered. It's all about faithful representation. To make all this a bit more real, we're going to follow a simple example all the way through. Imagine a software company. They've just signed a 1-year deal that gives a customer access to their software and includes a one-time installation service. Got it? Okay, let's apply step 1. Step 1 sounds obvious, right? Identify the contract, but it's absolutely foundational. We have to figure out if we even have a valid contract according to the standard's very specific definition. This is like the first checkpoint. If there's no contract, the rest of the model doesn't even apply. So to get through that first gate, IFRS 15 gives us a 5-point checklist. The contract has to be approved with clear rights and payment terms. It needs to have a real business purpose. And this one's huge. The company has to believe it's probable they'll actually collect the money. Once you've ticked all 5 of those boxes, you're good to go. Okay, so we've got a legit contract. Now we look inside that contract to find the specific promises we've made to the customer. In the language of IFRS 15, these are called performance obligations. Really, this is all about breaking the contract down into its core promises. Now, the key word here, the one you really need to remember, is distinct. A promise only counts as its own separate performance obligation if the good or service is distinct. And that just means the customer can benefit from that thing all on its own. So let's jump back to our software example. We've got 2 promises, right? The installation service and the 12-month software access. Are they distinct? Yep, they sure are. The customer could get the software and hire someone else to install it. And the company sells subscriptions without installation all the time. So we have 2 separate deliverables, which means 2 performance obligations. All right, we've identified the promises. Step 3 is about figuring out the total price tag for the entire contract. This is the total amount of cash the company expects to get for doing everything it promised to do. But, it's rarely that simple, is it? What if there's a bonus involved, or a discount for paying early? Or what if there are potential refunds? IFRS 15 lumps all of this uncertainty into one bucket and calls it variable consideration. And the standard gives us 2 ways to estimate that variable amount. You've got the expected value method, which is basically a weighted average of all the possible outcomes, great for when you have lots of similar contracts. Or you can use the most likely amount, which is just what it sounds like, the single most probable outcome. That one's perfect for a simple yes or no kind of bonus. So, quick check-in. We have a total price from step 3, and we have our separate promises from step 2. Step 4 is where we connect them. We've got to take that total price and slice it up, allocating a piece to each individual promise we made. The rule here is actually pretty simple and fair. You allocate the total price based on the relative standalone selling price of each item. In other words, you just ask, how much would we charge for each of these promises if we sold them separately? So for our software company, they look at the normal price for just the installation and the normal price for a 12-month subscription. The total contract price is then split between those 2 based on that ratio. And as you'd expect, the subscription is going to get a much bigger slice of that pie. And here we are, the final step. This is the moment of truth, where we actually get to book the revenue. We know our promises, we know the price for each one. The only question left, and it's the most important one, is when do we recognize it?
IFRS 15 makes a really crucial distinction here. Is the value delivered all at once, at a point in time? That's when control of the good or service transfers to the customer in a single moment. Or is it delivered over time, where the customer gets the benefit continuously?
Now, let's apply this to our example, and it all just clicks. The installation service, that gets done and it's finished. Control transfers at a single point in time, so all the revenue we allocated to it gets recognized right away. But that software access is delivered day in and day out for 12 months, so the revenue for that promise is recognized smoothly, month by month, over the whole year. So to recap, you can see it's a super clear and logical flow. You start by making sure you have a real contract. Then you find the individual promises inside it. After that, you figure out the total price, you allocate that price to the promises, and finally, you recognize that revenue as you deliver on each promise. And it always comes back to this. Every single one of those 5 steps is there to serve this one core principle, to make sure the revenue you report in your financial statements accurately tells the story of the value you are transferring to your customers. And that's the 5-step model in a nutshell. You know, the biggest takeaway here isn't just about some accounting rules. It's a completely different way of looking at your business. It forces you to see every contract not as one single deal, but as a collection of distinct promises. And understanding that story is how you really understand how a company creates value.